with me now is Prashant Jain, a very well-known fund manager at HDFC Mutual Fund. Sir, thank you so much for joining us here this afternoon. Just wanted to understand that, what do you make of the recent run-up that we've seen in the market? You look at the macros, you look at the numbers. What is the sense that you get? What is market factoring in, and what essentially, a macro uptick that we've seen?
I think it's very hard to say what exactly the markets are thinking, but I think the economy is clearly improving. And you can look at various indicators like I will start with the fiscal deficit, the current account deficit, interest rates, inflation. All these macroeconomic indicators are improving. I think what is missing so far is the IIP growth has still been quite weak, and the real growth what we have been waiting for is not yet visible. But I think what this government is trying to do is to revive the capital expenditure cycle, which takes a bit of time. And I think a lot of steps have been taken in the last 2 years. And I'm hopeful that before the end of the current year, we should see some result in terms of uptake in growth. As far as the markets are concerned, I think if you look at market cap to GDP, it is quite reasonable. In fact, it is below probably long-term averages. But PE multiples are not so low. And the reason for this is that the profitability of Indian companies is still quite weak. Rather, it is near 2-decade low. There are few sectors like corporate banks, the engineering companies, the metals companies, the cement companies, where profitability is significantly below long-term averages. And that is why the P's don't appear to be as low as what market cap to GDP is suggesting.
Right. So, if we just look at the PE function, just first globally, the money has been very high, or liquidity has been very strong. That itself has just re-rated the PE. Is that a cause of worry?
Yeah, I think markets are always volatile and hard to forecast over short to medium periods of time. And I mean, to be honest, the index has not done much over last many years. I mean, pre-Lehman index was 21,000.
Right.
And today you are at 28,000. So a 40% return in a fast-growing economy, inflationary economy, I don't think is a lot of returns. So I think this index is going up because probably the expectations were even lower. If you see some of the banks when they declare numbers, there are still slippages, but the stocks are not falling, probably because the expectations were even low. I think this is a very polarized market, if you ask me. There are pockets of great value, and there are companies which are very high quality but very expensive. And in that high quality bracket, I think the expectations, to my mind, what the market expects are higher than the reality, or what is my assessment. But there are pockets of value where the market is extremely pessimistic. And I think that is where the big surprise can come over time.
Right. Just the point that you made that markets are polarized, and we've seen quality of earnings for a few companies being very good over a period of time. Do you think overall the quality of Nifty 50 earnings is also improving? What is delivering continues to deliver. So maybe, the laggards may just play catch up and overall EPS growth may be higher?
I think current year onwards, we should see significant growth in aggregate earnings for the Sensex. It is true that for the last 2 to 3 years, the earnings have not grown. And the reason for that is what I mentioned to you. If you look at the profitability of corporate banks, if you look at the profitability of the metal sector, if you look at the profits of the engineering space, these are 3 sectors where the earnings have fallen by nearly 50% in last 2 years. And because of this drag, the aggregate earnings have not grown. But I think with the extremely low base of the same 3 sectors of last year, I think now we expect over next 2 years earnings on these 3 sectors to nearly double. And that is why I think the aggregate EPS growth from current year should be quite reasonable.
Right. So, most of the companies, that we've been looking at in terms of numbers. So what is delivering has been delivering. But you believe that what has not delivered in the last 3-4 years, dynamics have changed, and there we could see a better delta?
I think so. And even the sectors what have delivered very high earnings growth for last few years, you can see that now the biggest disappointments are in those spaces. If you look at the results of the consumer staples companies, if you look at the results of the pharmaceutical companies, there are serious disappointments. And not for one quarter, but I think for last 3-4 quarters this has been happening. So I think those sectors, this has been my view that these sectors like consumer staples, pharmaceuticals, they will see very low earnings growth, and much lower than what the markets are expecting. And I think there should be a better performance in earnings. Earnings should revive in sectors which have seen a sharp pain in the last 2-3 years. And these are the same sectors what I earlier mentioned.
Right. So, generally our market is said to be a very growth market and people tend to chase growth. But, most of the sectors that you just mentioned, the growth visibility seems to be very, very limited. So, how would essentially you justify the current run-up in these sectors and what market is expecting?
So, it is true that India is a fast-growing economy, and in such an environment, most businesses tend to grow. And therefore, growth investors have been very well rewarded in a country like India. But there are periods when growth can become very expensive, or the growth may move to some other sector. And if you go back to a period, let's say between 2000 to 2008, we saw that some of the best performing sectors were the old economy sectors like capex, engineering, construction, commodities, banks, including corporate banks. So I think the economy is in transition. So high inflation is now low inflation. Interest rates are moving lower. A lot of work has been done to revive the capital expenditure cycle. And I think the next few years we should see sectors which have not done well in the last 3-5 years, they should do better than the favorites of last few years.
Right. One thing changed in the last 3 years has been the emergence of the mid-cap and the small-cap space, especially in the last 18 months. Do you think because flows with DII and mutual fund are very strong and they are comfortable investing into even smaller companies because they can meet the management, they can visit their plants, they can keep an update about what's happening. Is that the reason why that sector has re-rated itself?
I think it's hard to, different people may have different opinions on this, but my take is that whatever portion of the market is doing well, that attracts the attention. And over time it becomes extremely more and more popular because it's a winning strategy. So we have seen this play out over last 2.5 decades in different spaces in the market. And last few years, you are absolutely right, the mid caps and the small caps have done extremely well. And there is a natural tendency in many people to buy what is doing well, and I think the same trend is continuing.
Right. Overall, for the mid-cap space, you think earnings have been better or good? I mean, they don't need the economy to grow like 7-8% and an individual sector can do well. That is also a reason why mid-caps are doing well, at least select sectors?
I think that is a great misconception in my opinion, that mid-caps don't need economy to grow. So, in fact, in my opinion, the larger companies in the same sector, in the same spaces, when they are competing with smaller companies, the bigger companies actually do better in most of the cases. So you will find that, we can discuss any sector. You can discuss cars or mutual funds or even banks or insurance companies or battery companies or bearing companies. You will find that in each of these industries, in a majority of the cases, the bigger competitors are growing faster than the smaller companies. But I think what is happening is that there are a lot of new business models that are evolving, and at the start every business is very small. And there could also be lots of businesses because India is such a large, diverse country. The number of mid-caps runs into thousands. So if you dig hard enough, you are able to find some stock which has escaped the attention of the market and therefore you may buy it cheap. But today I think if you look at the aggregate PE of mid-caps or small caps versus large caps, I think it's quite obvious that the mid-caps and large caps are more expensive than the mid-caps and the small caps are more expensive than the large caps. This has not happened in the past. So if you look at in the past, large caps used to trade at a premium, which is not happening right now. And no one knows exactly what will happen, but I am not very comfortable with this situation. So what I can say is it would be wrong to extrapolate the significantly higher returns of small and mid caps that we have seen in the last 3 years over the next 3 years.
Right. If you just look at the market, say from December, we've just been about 8%. And if you look at a dollar return, if you're a FII and you measure dollar returns as well, it's been hardly anything. But in the mid cap space, there has been return. That is the correct way to look at it, that markets have really not done anything, and we were just playing in a range, and that's why fund flows may continue. Overall valuation in the market may be decent.
See, I think what is happening is that certain large index heavyweights are not doing well. So there are quite a few large caps which have done extremely well. Like the oil companies have done very well, Maruti has done extremely well. So there are quite a few large caps which have done well, but some of the big index heavyweights are not doing well. Because of that, if you look at the large cap index versus mid cap index, there appears to be a gap. But generally what you are saying is right, that the mid caps and the small caps have continued to do extremely well. And people like me have been saying for 6 months, 1 year, that mid caps are expensive. But that trend has nevertheless continued so far.
Right. Let's talk about sectors and what essentially is doing well. So, retail banking, I mean, any company, any NBFC that we are talking to, just wants to grow into that space. They want to launch new products. They are hiring new people in that space. So, you're saying that corporate banking would do well. So, retail is getting towards a bubble, or, it's getting towards a fairly priced zone?
So, retail banking is a secular growth business in India, because the retail loans to GDP are extremely low in India. So I think retail banking will continue to grow. So I don't think it's approaching a bubble. It is reasonably valued, slightly expensive, but then it offers high quality growth, sustainable growth, no asset quality challenges. So I think as the sector grows, it should continue to do well. Corporate banking is a more cyclical business, because the corporate profitability itself is very cyclical. And right now we are sitting at the bottom of a corporate profitability. So margins in India, I think last year were near 2-decade lows. And because of this, there is extreme stress, lot of stress on the corporate banks. We know the NPAs, we know the provisioning costs. But I for one believe that this is a cyclical issue. It is not a permanent problem. And by the time we get to FY18, this problem would have been substantially resolved. And we will see much higher levels of profitability in corporate banks. Right. Let us go back 4 years in the oil companies. So a classic example again. The profitability of these companies was extremely weak. They represented deep value then. And today when the real profits have come, you can see these stocks have turned out to be extremely good. So I think corporate banking could see something similar over the next 2 years.
Right. So for retail banking, one big change has been CIBIL or various other credit rating agencies, which have done a great job. So that's why people don't default so easily. Now with the corporate side, we are seeing, SEBI and RBI work together. We are getting norms where, if one group company defaults, the other group companies' ratings also go down, or they don't get loan, or they get loan at very expensive levels. Things are changing as far as, the overall auctioning process or liquidation of assets is concerned. You think a CIBIL sort of a model can be created on the corporate side as well?
I don't think so. These are two very different models. See, one should not say that all companies which are not able to pay their honor their commitments are doing it because they don't want to. See, if the problem in a company, if there are 10 companies in a sector, if 1 or 2 are facing problems, then you can say it is specific to that company. But if 8 out of 10 companies in a sector are having trouble, then I don't think the companies are entirely to be blamed. There are some challenges in the environment, in the economy, or in that sector itself, or in government policy. And if you look at bulk of the NPAs in India are in 4 sectors, 3 or 4 sectors. And virtually every company in these 4 sectors has had challenges. So I think, yes, companies definitely, there would be differences across companies, but I think as the issues facing these 4 challenges get resolved, I think these NPAs should get resolved over next 2 years. And of course, the laws did favor, probably unfairly, the borrowers, and a lot of laws have changed in India. And going forward, I think it will be a more balanced regulatory framework between the corporate borrowers and the banks.
Right. Recently we've seen PSU banks, at least in Feb and March, being at an all-time low, or probably seeing very negative returns. Do you think people just forgot that they have a franchise value associated to them? So something like a SBI, something like a PNB, they have a very big franchise value and a very big base with them.
So I think, it is not specific to this case. So markets are always giving a lot of focus, lot of attention to the short term, to the near term.
Right.
And one has experienced similar situation with different sectors at different points of time. I gave you the case of oil companies. Even consumer companies 8-9 years back, 10 years back were in a similar situation. No one used to find them interesting at 12 and 15 PE multiples. So I don't think it is that surprising, because markets give more weightage to the current situation, and when currently there is a problem, they get over discounted, and that is where an opportunity is created for someone who is willing to think slightly longer term.
Right. So you mentioned about corporate banking. One of the biggest lenders, or one of the biggest clients, would be infrastructure space. How would you look at the cap goods and infrastructure space? Are we seeing a pickup? Because recent data of IIP, maybe even CMI, new projects commissioning, stalled projects, the data is not looking very, very positive.
So that's what I said in the opening remarks, that IIP progress has been extremely weak, and that is where one is hoping that in the next 2-3 quarters one should see meaningful pickup. See, to revive capex is not an overnight job, because it has the involvement of lots of agencies, lots of government departments. Corporate balance sheets have been under stress. There have been regulatory challenges. So a lot of work has been done, and I think before the end of the current year we should see some progress there. There are few sectors where we are seeing good progress, like roads, railways, in power T&D space, and I think before the end of the current year we should see very good orders coming through, even in the defense side. But it is a fact that the private sector capital expenditure is not picking up, and I think it will still take some more time. It has got less to do with the government and more to do with the fact that capacity utilization in some of the sectors is still weak, and in some other sectors the balance sheets are stretched. So it will take time to solve these problems, but I think before the end of fiscal 18 we should start seeing reasonable revival in private sector capital expenditure also.
Right. A lot of big groups or big private sector players, the confidence seems to be very low. Do you think that is changing now? We have seen 2 years of the government, we've seen changes in policy coming in, environment has changed for lending itself. Have you seen that change coming in?
Yeah, I don't think we should generalize like that, because some of the groups which are in pain, they are the most visible. They make the maximum headlines, and therefore they are top of mind recall. So yes, it is true that 4 or 5 groups are in some pain. But I think there are lots of groups who are in reasonably good shape. But if they are not investing, it is not, to my mind, for want of confidence. They are not investing either because they have surplus capacities, or because the profitability of the industry is extremely low right now. So I don't think it's a question of confidence. I think almost everyone would agree that India represents one of the few economies in the world which has immense growth potential, and the future is definitely brighter than what we have experienced over the last few years.
Right. We've seen a lot of asset sales, the corporate stress that you're saying, to try and revive that. Do you expect that to continue, and that in turn gives an opportunity? Just to give an example, not taking names, Ultratech has done a great job in acquiring a lot of assets. Something like that can be done in the engineering space as well, or maybe in some other space as well. That is a big opportunity.
So to be honest, actually asset sales have been much lower than what should have ideally happened, and there could be many reasons for this. So there are, in every account there are 10, 15, 20 banks. There are many regulatory challenges. So for some reason or the other, I think the asset sales have not happened to the extent it should have happened. And that actually has reduced a lot of value because interest has continued to grow in some of these balance sheets. So I think this last scheme of RBI, the S4A, is a very good step. It's a very effective step. Probably it should have happened earlier. See, once you do an S4A, once you fix the company's balance sheet, after that you can sell the company. But to sell a company which is very challenged is extremely difficult. So I am quite hopeful that this S4A should prove to be more effective than some of the earlier initiatives.
Right, and a lot of big groups with cash lying or decent balance sheet. Do you think if they acquire these assets and we see a demand pickup in their industry, it could prove to be quite meaningful?
See, S4A will not necessarily result in a sale of the company. It will basically mean that the debt will be reduced to a sustainable level, and the promoter group will also take a haircut to their shareholding so that the pain is shared between the bond and the equity holders. Once you bring a company's debt to sustainable levels, then I think it is more reasonable, more pragmatic to expect it to be sold should the need be still there. Should the bankers and the management feel the need to sell it, but then I think it is a more saleable, because it's a running solvent business with economic value, it's a stable value, a stable business. So then I think more M&A can happen.
Right. The other sector that you mentioned was metals, probably steel. Steel numbers, we've seen a few of the large cap ones, mid cap ones also coming in. They have been very good, but maybe one would say that there is a protection which is there, which because of which the numbers are looking in good. How would you just rate the steel cycle and the excess capacity in the steel globally, which has been spoken about?
So I think it's a well-known fact that steel is in deep oversupply globally, and that's why you need the MIP. If steel was not in oversupply, you would not need the MIP. MIP, I think, is a valid, it is justifiable. And I think most countries in the world are giving some protection or the other to their steel industry, and I think India is doing the same. If you don't do this, what will happen? Your industry will not make money, and India, which has huge requirements of steel and which is very competitive in making steel, we have both ore and coal, you will start relying on imports, and once you kill an industry, it is very hard for it to revive. It will take very, very long time. So I think what is happening is right, and probably it should have come 3-6 months earlier than what it actually came. Then the problems in India would have been probably lesser. China is curtailing, they are mothballing or scrapping excess steel capacity. So I think 2 years down the line, the problem of excess capacity may still be there, but it will be less acute, less severe than where we are today. And today, if you look at Chinese steel prices, they are quite stable. And even if MIP were to be dropped with the safeguard duty, I think steel prices should broadly be where they are even today. But of course, then you open yourself to the risk, what if tomorrow Chinese steel prices drop again? But at this point of time, I don't think MIP is making a very big impact to the steel prices.
And the recent run-up in the steel stocks, still they are fine, because when these sectors rally and when they suddenly become into overcapacity, they can become 5 baggers, 10 baggers from the lows.
So that is the nature of a cyclical that, I don't want to, it's hard to comment on the sector because it's a very volatile sector. But I think there is still some value if you think slightly longer term, and if you are not very bearish on global steel prices.
Right. So again, just taking a name as an example. So we have seen the Vedanta Kane deal coming in. It has simplified the structure in a big way if it goes through, say, in this manner. We've seen other steel companies, trying to sort out their debt issues. We've seen other metal companies like Hindalco starting their new capacity. You think overall the fundamental changes that are happening in the sector, they are just being ignored?
See, I don't think structure by itself can create create value. So yes, simplification can lead to some. So what is happening is, I think in the Vedanta Kane case, the cash was, there was a mismatch of cash. One company was cash poor, one was cash rich. despite it being the parent company. So I think that access to cash will improve the overall health of the balance sheet. As far as steel companies are concerned, I mean, the cash flows have improved a bit, but I think there is still some way to go before we can say that some of the weaker companies are stable or in sustainable shape. And that's why the S4A is needed by probably some companies in the steel sector.
Right. So, you've spoken about pharma and consumer, and probably you're seeing changes over there. I mean, one sector where we have seen, a lot of companies declaring numbers is IT so far. And, they were always known for, just growing YOY by 10%, 8%, 11%. This time around, it was their strongest quarter, but, we've not seen major growth. Do you think structurally we would see IT slowing down the growth, which means that, it may not be a attractive sort of a sector from here on?
See, I think IT is a sector which is globally competitive. It's a very high quality sector because it needs very little capital, and virtually the entire profits what are generated are free cash flows. And these companies have extremely good governance standards. But fact is that as this industry has become larger and a larger part of the global IT spend, growth rates have to slow down. So 15 years back, they used to grow at 100%. 10 years back, the sector was probably growing at 30, 40, 50%. 5 years back, maybe at 20%. Today, they are growing at 10%. So I think it's hard to say whether they will grow 8% in a year or 12% in a year. But I think the market recognizes that this is not a very high growth sector. It is a growing sector, but not a very high growth sector. And the multiples are reflecting that. If you look at the multiples of the IT sector, they are probably half of the, or less than half of the consumer
Right. Just a last word, for our viewers. They invest in your funds, they invest in other funds. And about 1.5, 2 years back, you had told us that if you have any cash flow free for the next 3 to 5 years, you can, go ahead and invest into any good equity fund. You still continue to maintain that despite the valuations?
So valuations are not, they have not run ahead of fundamentals. See, whenever markets go up sharply, there is a section which will always feel that markets have probably run up. It depends on what how long you are thinking. So if market cap to GDP in India is quite reasonable. The GDP is growing in rupee terms by 12-14% a year. So if you think 3 years, if you think 5 years, I see absolutely no reason why that same view is not right. And my take on this is very simple. Whatever is the portion of one's wealth which you can spare for 3 to 5 years and on which you can tolerate emotionally and financially 10 to 20% temporary downside is the right asset allocation for equities.
Right, Prashant. Thank you so much. A pleasure talking to you.
Pleasure. Thank you.